Let me get my timer started so I'm keeping myself honest. Good evening, everyone. I'm not used to saying good evening for these presentations. I'm used to saying good morning. So thank y'all for being here. It means you really want to be here if you're here on a Wednesday evening instead of forced participation at a 9 a.m. call at the office. So as mentioned, my name's Carl Whitaker. I lead up our team of market analysts and economists at RealPage. And if y'all have any questions about RealPage, then I'd be happy to share some more information after the presentation's done. Really wanted to stay hyper-focused on some national trends and then drill down into some Texas trends this evening more specifically. So I'm going to bounce around on the next few slides here between some national talking points. I think it's good to just set some context for, hey, here's the state of the economy, here's the state of the national apartment market. We'll talk about the Texas markets in particular, and then it sounds like we'll leave a few minutes afterwards for questions. Is that right, James? It works? Okay, so if you want to hold on to your questions, we'll answer those afterwards, but please do be thinking of those questions along the way. So I wanted to start here real quickly by looking at some of the national trends that we're seeing. I think when we first look at rent growth and occupancy, actually, do y'all mind if I pop this out? Okay, there we go. Yeah, that's a little bit easier. When we look at rent growth and occupancy, that's always going to be downstream of supply and or demand. You know, those two things don't move in a vacuum. And one of the things we're seeing is that demand remains really strong from the renter perspective. The economy still churning out jobs, demographic tailwinds, those are still in place, wage growth, that's still happening. All those traditionally strong economic predictors of apartment demand remain in place, and that side of the market remains really strong. The difference is that we're hitting the highest level of supply that we've seen since 1986, and the pace of the demand improvement, while it has been real, it has been strong, hasn't been strong enough to match the concurrent amount of supply. So again, go back to Econ 101. If supply demand curves, as demand improves, but supply improves more or increases more, your pricing adjusts. But I wanted to spend a little bit more time on that talking point simply because when you look at the rent growth challenges in the market, you look at the occupancy challenges in the market, we're of the school of thought that that's not demand driven. That's a supply driven phenomenon. Supply will eventually subside. So we don't really have any concerns about the market over the long haul. Now it might be a choppy few quarters here, but long haul, I think we're in really good shape, which really kind of touches on those next bullet points there. Another kind of key trend that I think is worth mentioning is that this is the fourth straight month that occupancy is held at 94.1%. So the fact that occupancy is now holding stable, again, kind of tells you that we've maybe found the floor. You know, you've heard the rallying cry of survive till 25. Here lately I've been saying, have we found the floor in 24? I don't know that that's necessarily like a cheerleader style rallying cry, but I do think that there is some truth in that the worst of the market's performance is behind us. Construction starts, we'll talk about that here in a little bit. Again, we talked about the economy, things remain good, and as y'all well know, the investor appetite, that's still there. It's just that interest rates are a little bit finicky for the time being, but the appetite for the capital markets remains really, really strong. So getting into some of those specific data points now, I'm going to first start here with absorption. Absorption is really a measure of demand that we use. You think of it basically as the net change in number of occupied units from one year to the next. And in first quarter 2024, the nation absorbed 320,000 units on net. Not only was that much better than the same time last year when there was net move-outs from over a quarter, about 200,000 units, but look at that average since 2010. The absorption rate, kind of like James showed, that absorption rate over a long period is actually really, really strong. Now again, we're adding more supply than the market can realistically absorb, but this is a key trend for why we think the market remains in pretty good shape. Now when we drill down into Texas, I love this slide right here, because again, I think it shows us that the worst is indeed behind us. This is looking just at a 90-day absorption tally. First quarter 2023, Texas absorbed about 300 units. For a state the size of Texas, that's nothing. You know, it wasn't negative, but that's, you know, a drop in the proverbial bucket. Today, however, 18,000 units absorbed in first quarter 2024, a 53-time increase. Now granted, that's on a small denominator, but to me this says, hey, that weird household formation freeze that we had over the past couple months, the dam may not be fully bursting, but we're at least seeing some thawing around the edges. And a lot of this comes down to, I'm preaching to the choir here, but a lot of this comes down to strong job growth, strong population growth. Texas has those two things in spades. We'll talk about the individual markets here in a little bit, but one thing that I think is encouraging to see is that it's not just the big markets that are getting in on the population growth and job growth frenzy. You know, James talked a little bit about Waco there. I think that's a hidden gem in some ways, where maybe getting some population growth that over the past two economic cycles it wasn't necessarily privy to. So anyway, long story short, on this side, or on this slide rather, the demand side of the equation remains pretty favorable. And then this is maybe a little bit busy to share up here, but really just kind of benchmarks population growth in the major Texas metros. Up here up top, you have Austin and Sherman Denison. Both of those markets rank in the top 20 of the nation for growth since 2020. In the top 5th percentile of the nation for population growth, 8% in Sherman, 7.5% in Austin. But going down this entire list, you know, it's just, again, almost any market you can think of is getting really strong, really favorable population growth. Now, one thing I will say, we get this question a lot. We hear, oh, you know, Austin got all those Californians that moved in. Well, now people are moving back to California. Or, yeah, people came to Dallas, but they're not staying there. While the pace of move-ins to those markets has slowed, those markets are still growing. You know, Williamson County, for example, in Austin, 2022, I think it was, grew 4.5% to 5%. 2023, it grew about 3%. So it's not like population growth stopped. It just slowed a little bit. It just came back to a more normal level. Again, we're adding more supply than what the market's absorbing, but that should be a short-lived phenomenon. I probably sound like a broken record at this point, but the demand side of the equation, we don't have any concerns with, barring some sort of truly unseen black swan event. You know, that's always a possibility, but I don't think any of us realistically see that on the horizon. Now we talk about the supply side of things, and this is where the market's feeling the heartburn today. Almost 500,000 new market rate units added over the past 12 months. Keep in mind, this doesn't count for build to rent, the single family rental segment of housing. It doesn't take into account things like senior housing, doesn't take into account affordable housing. So realistically, this number is probably at its highest since at least 1986, maybe even a little bit before that. Now, the one thing I'll mention on this slide is when you look at this percent inventory growth, that shows you the relative number of units delivering in a given year. Today's growth of about 2.5%, it's still below the 3 to 3.5% of 30 plus years ago. I think more importantly, what this doesn't show is how many more working age adults we have in 2024 versus how many we had in 1986. And I think that's where, you know, any of y'all that maybe harken back to the S&L crisis that was happening in Texas a couple of economic cycles ago, the amount of building today, while it's more than we've seen in recent years, we don't think it's anywhere near that period of true broad-based overdevelopment, because you simply have more renter households that can absorb those apartments as well. Now, a little bit of a busy slide here. I won't spend too much time on this, but just kind of to set the stage, this is basically looking at the national absorption, national supply numbers. And again, absorption is trailing supply, but notice how that gap is closing. That's where we think the market is closer to the floor than it's been in the past couple years. Now, one thing I will mention too, and this is going to be true in the Texas markets especially, it's going to take a few quarters of absorption to pace ahead of supply to basically backfill what didn't happen over the past 12 or so months. So there's going to be a little bit of a supply overhang. That's going to be something that takes a little bit longer to absorb, but still we're moving in the right direction. Using a football analogy, we're getting the ball down the field now, first down, after a series of 3 and outs and maybe some fumbles that we saw in 2022. James?
Carl, what happened on the 3 quarters?
These right here? Yeah, it's a good question. So I intentionally highlighted, or I guess, I don't know if I'd call it highlighted, I intentionally called out here the only other times where you saw negative apartment absorption, 2000s dot-com bubble, Great Recession. Those were true capital R recessionary environments, as we all know. 2022 and 2023, we don't necessarily think that we hit a recession. You know, it depends on the measure. There's some that say, yeah, we had a brief period there where we technically did go negative, but I think realistically what happened here was two things. One, a lot of the demand that happened in 2021 was a pulling forward effect. You know, kind of think of the psychology of 2020. A lot of folks that wanted to make a move, they just couldn't physically make that happen because everybody was on lockdown. Well, the people that could make a move, the ones that moved from New York to Florida, for example, really started kind of spurring this, this big acceleration here. I think the other thing that you see is that folks that were going to move in 2022 or 2023 said, hey, right now is a pretty good time to move, because this was also before all the rent growth had come back to the market. So people were getting really good deals on apartments. They also said, hey, I'm sick of living with my roommate. I'm working from home, 2-bedroom apartment. Doesn't make sense when both of us are working from home. So you kind of had this big unwetting of the market. But at some point, that meant you were going to have to forfeit some ground. So basically, I would take it as a lot of the demand that happened here would have happened in 2023 in a quote unquote normal environment, but we're not necessarily in a normal environment still. Yeah, really good question there though. All right, like I said, I've got more slides here that I'm realistically going to cover. I do want to make sure I get some talking points on the Texas market, so we'll shift over to that here shortly. One of those first talking points, looking at the relative number of units delivered as a percent of existing base there. For every 100 apartments that existed in Texas, every 100 units that existed in Texas at the end of last year, another 3.5 were delivered over the past 12 months. So that's kind of an applied way to look at that. Not necessarily a huge number on aggregate, but when the denominator gets that big, it starts getting watered down. When you look at Austin, that number is getting closer to 10%. So for every 100 units that exist today, another 10 are going to come online between now and the end of the year. That's where the Austin market's feeling some of that slowdown despite strong demand. So I shared that chart earlier of supply demand, how those two numbers are tracking next to each other nationally. Here is the Texas number. So a couple things on this chart. Blue column is your annual supply, green column annual demand. To the question James had earlier, same thing. Texas had this pulling forward effect where effectively 2 years worth of demand happened in 2022. Well, that meant that you forfeited some ground in 2023, but it's this orange line that I would call the most attention to. You notice how that orange line is getting closer to equilibrium. That tells you that supply and demand are now getting close to matching each other. It's not going to happen in 2024, but we're moving the ball in the right direction. The market, from a demand perspective, has improved. And I think you're starting to see that in occupancy rates. It's not necessarily showing up fully, and it's not showing up in every property, but this is looking at the statewide occupancy rate, and then it's year over year change. So yes, occupancy is still coming down a little bit year over year, but notice how this is leveling off. That year over year change is starting to stabilize. To me, once more, that says that the market's getting close to finding its equilibrium. Now the challenge is, just as the presentation earlier shared, in some submarkets, the occupancy rates challenge to hit 92, 91, even 90%. In some markets, some submarkets that is, in San Antonio, some in Austin. Not necessarily seeing it as much here in DFW, but still seeing it a little bit in Houston too. So I think this is where, as with any real estate, it's all going to be local. So you will find some instances of localized differences from the statewide numbers.
So I think if you go back to that slide, I think this is why you see some of the lenders kicking the can, because they're seeing improvement in occupancy, they're seeing improvements in rents, and they only see like the next 12 months being difficult, but then the following 12 months, that rent growth coming back and that absorption coming back.
Yeah, it's actually a good point on the more applied side of things. I hadn't necessarily thought of that. Oh yeah, thank you. That was probably in the way. All right, so like I said, there's more in here than I'm realistically going to get to. This is just kind of a chart to show you, hey, supply is a really good predictor of whether or not rents are going to be growing. And really the intention of this chart is, as you read from top to bottom, markets that delivered the most supply saw the biggest rent cuts. Markets that delivered effectively zero supply still saw rent growing. I think the takeaway there is that in the absence of a lot of supply, if absorption is normal, you get normal rent growth. And that's where we think by 2025, certainly by 2026, the markets will start to improve in terms of rent growth. Now this chart right here too, this is one that we've shared a couple times on LinkedIn, and honestly it kind of surprised us, but one of the more interesting phenomenons we've seen is that a lot of the supply that's delivered, new supply is obviously going to deliver at a very top of the price point spectrum by the time you account for building costs and costs of land, et cetera, et cetera. But believe it or not, in the fastest growth neighborhoods, supply has had the biggest impact on Class C housing, the most affordable price point. And I think what you're seeing happen is as so much supply delivers, it waters down the top of the market. A Class A property says, hey, I can offer a 1 month free concession and get somebody out of a Class B household into the Class A product tranche. Well, then Class B has to dip into the Class C tranche, and Class C can't necessarily dip into a bucket below it. Now that's oversimplifying some things, but I think that's the general takeaway that we are seeing. But again, the good news here is that the supply wave that we're seeing isn't going to last forever, and we're going to see that start to improve, performance that is, start to improve, in our view, by 2025.
Carl, go back 2 slides.
Yeah.
So on this slide, where's Dallas-Fort Worth? Is it 2.5, 5?
So DFW on aggregate would be right there, yeah.
Okay. And then Austin is down on the far right?
Yeah, Austin would be kind of in that tranche.
Okay, so everyone's getting pounded in Austin.
Yeah. Yeah, and this is where it comes down to the submarket in particular, where Cedar Park in Austin, for example, incredible growth. Rents are falling the fastest, but if you're in HEB, for instance, not a lot of new inventory there, you're actually still getting some rent growth. So that's where the submarket story is really going to matter. All right, a couple more things before we get to Texas specific markets. Rents for the country, they're growing, yes, but they're not growing all that significantly. On a new lease, you're getting about 20 basis points of growth. By the time you take into renewals, however, growing at 4%, you're getting a little bit of blended rent growth. You may hear that on the earnings calls. REITs talk about that a lot. So yes, you're getting some revenue growth. The challenge here is that by the time you account for expenses, you're not really getting all that much NOI or true significant revenue growth. But again, the good news, I think we've basically found the floor in the back half of 23 and going into 2024. One more chart here on concessions. We get this question a lot. Concessions aren't necessarily a thing, if you will, at the national level. The difference here is that at a submarket, it can become a problem where you have in Fort Worth, there's I think it's Burleson and Johnson County, something like 60% of vacancies are offering a concession. What's happening there is you're seeing more turnover as renters say, hey, I can get 2 weeks free if I move out across the street, all else being equal. I can afford a more expensive apartment, but the concession negates it. So it actually creates a lot more turnover. Nationally, it's not happening, but at a submarket level, you will see that happening. And actually, yeah, here it is. So parts of Fort Worth, seeing a little bit more of a concession headwind. I guess it was Southwest Fort Worth, not Burleson, that I was thinking about. But about half of vacancies offering a concession in some of those instances. All right, so any questions on the national overview before we get into a fastest 2 minutes of each of the Texas markets? Going once, going twice? Okay, and if you have some questions, and feel free to save them for later. The next few slides, what I did is called out some key stats in each of the markets. We'll get into a forecast on each of the markets, and then we'll go to the next one. But what I really specifically did here was bubbled in 2 or 3 key metrics that I think are the most important to watch in each of these respective metros over the next couple months. In Austin, occupancy market-wide, 92%. That means you have some submarkets that the submarket is approaching 90%. As James mentioned, that's kind of a magic number for a reason in the apartment world. The other thing is that they are still contracting year over year. And to nobody's surprise, a lot of that's construction driven. This is an incredible number. So this is Austin, which keep in mind is what, 1/6 the size of Dallas, 1/8 the size of Dallas. Look at the construction numbers relative to Dallas. You've got a lot more construction happening in Austin on a percentage basis than what's happening in DFW. So I'll come back to Dallas in just a second, but a lot of occupancy challenges due to the new supply. Now here's the thing, demand is, again, pretty good. You've got 14,000 units absorbed on net, so it's not like people aren't moving into these apartments. They're just not moving in as fast as what's delivering is delivering. Now the other thing that I wanted to mention in Austin, I think this is where the Austin market is probably going to be later to recover than most other parts of the country. I think 2026, maybe even 2027 is more realistic for the Austin market. New lease trade out, renters are moving in today for 7% less than the renter they're replacing. What's happening then is renewals are running up against a ceiling, and effectively Austin is now getting into an environment of negative loss to lease. If I move out, Paul's renewal comes in, Paul's paying $150 more than if he were to sign a new lease agreement at that same property. Guess what? Renters don't like that. They look online, they can see this data. And that's a tricky genie to get back in the bottle whenever your renewals are going out for more than your market rents. So I think that's where Austin's going to see a lot more of a challenge than some other parts of the country. But thankfully, mercifully, the demand side of the equation is really, really good still. So forecast here, I'll kind of let everybody digest that, but I think Austin, it's probably best to look at it from two perspectives. A 2-year view, going to be challenging. 3+ year view, we still really lack Austin. People are still moving there, still a great corporate relocation spot. I think the long-term outlook in Austin is still in the top quartile of the country even. Now, having said that, maybe now is a good time to buy in some ways because there's going to be some distress in the market. Just kind of depends on how much you believe in that long-term demand side of the equation. All right, so getting into Dallas here. Dallas, a couple stats that stand out to me. Yes, you're getting some negative trade out, but not necessarily all that much. Keep in mind too that this is the March number. That's still a kind of slow time of the year. I think by the time we get to the summer, you will be getting some positive new lease trade out. It won't be significant, but I don't think that number is going to stay negative throughout the entire year in Dallas. Because of that, renewals aren't getting pulled down all that significantly. You see the retention rate in Dallas of about 52% versus 47% in Austin. You kind of see how that loss to lease number starts to factor in there. The other thing in Dallas, occupancy is coming down year over year, but not as significantly as what we're seeing in Austin. And I think the big thing in Dallas is that, again, y'all are all familiar with the area. I don't think anybody questions the long-term demand capacity of DFW. It's going to be a market that job growth happens, population growth happens. All this supply will get absorbed, and because of that, you see our mid to long-term forecast in Dallas recovers quite a bit more quickly than what we're saying we think will happen in Austin. This is probably my biggest wow stat. For those of y'all that are on the highways here and are like, man, it feels like the highways are a lot busier than they used to be. Well, that's because they are. 500,000 residents have been added to Dallas between 2020 and 2023. Now, again, there's not as many people moving here today as there were 2 years ago, but to say that Dallas's population growth has stopped is, pretty asinine. Like the growth hasn't stopped. It's just come down back into the stratosphere after being in orbit for the past 2 to 3 years.
How many units were added? Any idea?
In that time frame,
you can look that up later if you want.
I think 70,000 were absorbed. So I think 70 is about the delivery number. So yeah, 70,000 units, 500,000 new residents. Now the one thing I really, really like about Dallas going forward, y'all probably hear about San Francisco, Seattle, Boston, New York. For the longest time, investors thought those were the core markets. Your core markets, you don't get a lot of revenue growth necessarily, but they're lower risk, low reward, they're stable. Well, the pandemic obviously changed that. I don't think anybody would describe San Francisco as a core market anymore. Well, it depends on who you ask, but I would argue that San Francisco is certainly a more high risk, high reward option, if not even a high risk, low reward option today. But Dallas, in our view, is kind of becoming the new core, where investors look at it in a similar way to the way that they used to look at a Washington, D.C. You know, the risk level is pretty low, the reward is there, you've got the liquidity. I think the size of the market, you know, today, it's just people look at Dallas different today than they did 20 years ago. And I think that there's some truth in that. So I think the Dallas story on the liquidity side, again, looks pretty good. Now, we technically split up DFW by our definitions. For all intents and purposes, it's one liquid or one contiguous market. But looking at a few things in Fort Worth, I do think the supply impact on the Fort Worth side of the market has been a little bit more significant. Now, obviously, Fort Worth isn't adding as much as Dallas is on an absolute basis, but I think where Fort Worth gets a little bit more, what's the word to use? I think where Fort Worth gets a little bit more challenged in high supply environments is that its jobs base tends to skew a little bit more blue collar, whereas Dallas tends to skew a little bit more white collar. So it takes a little bit longer to fill up some of these new units. Now, having said that, retention of 53%, you've got 53% of your rent roll is still renewing at a 4% growth rate. So again, I think the market's still getting some revenue growth. The trade out isn't as negative as what you're seeing in Dallas. But again, I would just call to this occupancy rate there a little bit lower than what you would realistically like to see in one of these high supply environments. But I don't think Fort Worth has any concerns by any means. And I do think that Fort Worth, if you're looking for an acquisition that doesn't necessarily come with the Dallas price tag while still getting the overall benefit of North Texas regional growth, Fort Worth is a good option to look at. So I'll leave that up there just to give everybody a second to digest. Again, I think the difference today is that Fort Worth is maybe slow, or maybe at risk of potentially slowing a little bit more than Dallas, just because it tends to skew a little bit more blue collar jobs.
Where's the supply in Fort Worth then?
Basically everywhere. So yeah, the submarkets that come to mind, Keller, which again, I think you kind of argue like, hey, that's basically Dallas, but Keller, Johnson County, and Weatherford, Parker County, on a percentage basis, at least. Those are the big areas. All right, so Houston. Now, Houston for a long time has kind of been it's been easy to kick Houston while it's been down over the past half of the 2010s economic cycle. You know, it's just every time the market seems to be getting on track, something unforeseen happens. Back in 2016, energy prices crashed, oil and gas market crashed. Well, ultimately, oil and gas is still the tail that wags the Houston dog, so to speak. It's not as dependent on that economic sector as it used to be, but still, you know, that energy price crash, that shock event, cratered demand, market was getting back on track. Hurricane Harvey happened, that tanked the Houston economy again. Market getting back on track. COVID happened, market tanks. You know, it's just always been something getting in the way of the market. Today, however, I actually think Houston over the next 3 years will be the best performing of the Texas markets. And the reason for that, first and foremost, this construction number. Yes, that's a big number, 30,000 units, but compare Houston market size to Dallas market size and look at the difference in construction. Houston's only delivering about half as much supply as just the Dallas side of the market. By the time you add in Fort Worth, it's about 35-40% of the supply. So I think the takeaway on Houston is that supply is going to behave a little bit more this cycle than it has in past cycles. Now, if I have a concern in Houston, it's, to James' point earlier, some of those submarkets, for whatever reason, just really struggle to stay above 90% occupancy. Houston's a huge geographic footprint, very different market segments within Metro Houston. So, you know, I think ideally you'd like to see that occupancy rate come up a little bit more, but by that same token, only down 0.5 percentage point over the past year. I think Houston's doing a better job of maintaining that healthy supply-demand balance that's a little bit aloof at some of the other Texas metros. Last thing on Houston, that retention rate of 53%, that's really good in the Houston market. Houston historically has a lot of turnover, a lot of concessions in that market, partially because the demand hasn't been there over the past 5 or so years. Today, I think that's changed. Now, the one challenge in Houston is forecasting the economy, and Houston's economy can be a little bit fickle, but one thing I really think also helps Houston is a continued improvement or a continued increase in international migration in particular. I think people think international migration and they think of the East and West Coast. Well, Houston's one of the biggest destination markets for international migration, and I think that that's going to really help support apartment demand going forward.
We've seen more distress in Houston because of this last piece that you didn't say, insurance.
Oh, insurance, yeah. Yeah, so insurance is going to be a tough one to get our arms around. Insurance costs nationally are up 30% year over year, 30% difference per door. In Florida, that's more like 45%. Houston's not quite Florida bad, but it's pretty dang close. So I think that's where, just like you said, some of the distress in Houston is coming up, is just from a simple, if you're not getting pretty substantial revenue growth, the OpEx growth is a little bit hard to get a hold of.
So it's on the right-hand chart, is that, are your occupancy projections going down to 91% by 25? Is that right?
Yeah, so it's calling for 91. I'm a little bit skeptical of the occupancy forecast because I think the economic data we feed in is being a little bit punitive on the Houston market. I think it's going back to 2015 and saying, hey, something happened here, in 2017, hey, something happened here. But I actually think this will improve in our next round of forecasts. My bold guess is that Houston outperforms the rest of Texas through 2026. No, I'm from Tyler, but yeah. All right, last one here, San Antonio. I won't go through this one in quite as much depth because I've probably already overstayed my welcome looking at the timer there, but new lease trade out is negative in San Antonio. I think it's only a matter of time before that renewal trade out comes down into like the 2% range, similar to what you're seeing in Austin. The difference in San Antonio is that construction really isn't out of control all that much right now. So I think San Antonio is maybe the one Texas market that can't quite get that demand lift off that you would expect, which is a little bit perplexing because of all the markets we've shared thus far, it currently has the strongest job growth. So I think San Antonio is just kind of a market that's a little mismatched right now in terms of supply-demand drivers. Lowest occupancy rate in the nation, 91% at the market level. I do think that parts of San Antonio still make sense to in the nation.
91?
Yeah, 91's at least among the big markets. You know, you have some smaller markets that are lower, like I think Shreveport, for example, is lower than that. But I still like San Antonio going forward. I think right now the market is just, it's still a little less mature, if you will, relative to the other Texas markets. Not necessarily a bad thing because you can invest in that market as it firms up. But right now I think it's just, it's still learning to walk and crawl relative to the rest of the markets that are able to run a little bit more. One thing I do really like about San Antonio going forward, however, is that as it remains affordable relative to Austin, I think San Antonio is going to capture more of the Texas migration trend than Austin does. Now, Austin's still going to grow faster, but I think San Antonio, from a relative perspective, just becomes a little bit more attractive for folks coming into the state because it's substantially more affordable than that of Austin.
Can you explain that first bullet, the loss to lease bullet?
Which one? Oh yeah. So that's the inversion of the rent roll, where the renewals are higher than the new leases. So trade out at -3% versus growth on renewals of 3.5%. It's only a matter of time before renewals, unless new lease trade out goes positive, then renewals are going to start. And again, I think that's why you see a low occupancy rate and high turnover here.
So people are willing to move across the street.
Exactly. All right, and then a couple more national slides here. The only one I wanted to talk about that related to Texas is looking at starts. Some light at the end of the tunnel, I think, in many ways. This is looking at just the actual number of new multifamily units started across the country. This isn't the census number. This is coming from RealPage collections. So if you see the census number, it might not match one-to-one. But about 380,000 units started over the past 12 months. Not only is that down 40% from where it was the same time last year, but we're actually below the 10-year average in terms of starts. So I think by the time we get to 2027 and 2028, you're going to look outside and say, hey, where did all those cranes go? Where's all this dirt that was being moved that I saw back in 2023 and 2024? Well, again, if you look back at the demand side, knowing that supply will eventually subside, demand, barring some sort of capital R recession, probably isn't going to forfeit ground. So I think the supply-demand overhang, or the supply overhang, eventually gets eaten up and does start to look better in the state. Looking at starts across some of the markets, yeah, you've got technically an increase in some of these tiny markets, but that's just more of a small numbers problem. By the time you get into San Antonio, Houston, Austin, you're starting 40 to 60% fewer units than you did 12 months ago. So if you can hold on till 2026 in a lot of these properties, then I think the market genuinely does start to turn around. And then again, you can see the left is how many units actually started, and then the middle column is how many fewer that was in the prior year.
When you talk to developers, what changes that number? The development starts.
Yeah, so interest rates are going to have to come down to a more palatable level, or construction costs are going to have to find a way to pencil out more justifiably, I would say. But it kind of comes back to the interest rate conversation. Some of the other thing too, I think we're seeing is kind of a wait and see. It's like, hey, kind of like you said with the transactions, if we don't have to sell right now, then what incentive do we have? If you don't have to build right this minute, then what's the incentive? Counterintuitively though, right now is probably the best time to be building, because by the time you deliver, you'll be delivering when this number is subsiding. So if you can find a way to build today, then good, probably worth doing, but the math doesn't always work out.
I don't think the banks are giving them money.
Yeah, and that's the other thing too, is the construction loan standards have really tightened. Construction delays are another component. A developer that's tied up on a project today that they had penciled in for this year, well, they haven't got to it yet. They haven't had a chance to start. So they're like, well, we've got the land, we'll hold on to it. We won't start the project until we're fully done with this one down the road. So it's kind of I don't think it's any one thing. I think it's kind of a confluence of factors, but I would agree that if you can't get the money, then you're not going to get the construction started. What is starting is largely groups that just have a really close relationship with their lender, and it's harder to come by the financing. So yeah, that is pretty much that. All right. Well, thank y'all so much, and I think I put my email up there. If not, happy to answer questions. So, all right.